Good afternoon, everyone. Hope you all have had a wonderful trading day. In today's video, we'll review the 4 different index futures markets, taking a look at how the volatility in the 7 to 8 a.m. Pacific hour really panned out in all 4 of those markets. Now, the way we'll focus in this is start by first assessing which one of the 4 different indices were the most volatile, and then after that, we'll review the specific trades using our fade setup. I'll leave a link to a video which goes through the exact rules of the setup, down to the nuances of where your entry should be, where your exit should be, where your stop should be. So that video will detail the specific trade nuances. In today's video, we'll review more about the volatility, how these different markets compare to one another, and what trades set up. Now, right off the bat, in terms of which markets were more volatile, the S&P along with the Dow were both on their conservative volatility box models. You can see that right here. We have a total of 5 futures volatility models available to us. And for those of you that have ever emailed me, you know I'm a huge proponent of having multiple volatility modules. That allows you to really adapt to whatever volatility conditions you may be having at any given time. You're not relegated to, say, only sticking with the scalper when, say, the market is moving something like this. So in today's case, the S&P was on its conservative volatility box models. The Dow followed suit with the S&P, also on its conservative volatility models. So if you take a look in the S&P and the Dow, they've broken outside of the scalper, the aggressive, and the doomsday aggressive, meaning there's a decent amount of volatility in both of these markets. Now the Nasdaq was a slightly different story. The Nasdaq was on its doomsday aggressive models, which is one below the aggressive. So in comparison to the S&P and the Dow, the Nasdaq today had the least volatility. Now when you add in the Russell, the small caps into the mix, the Russell was even lower on the volatility spectrum. The Russell was on the aggressive volatility box. So now if you had to rank the volatility of the 4 major index markets, given everything I've just said, the Russell would be the least volatile market, then the Nasdaq. After that, we really have the Dow and the S&P tied for 3rd place. So that's how the volatility breakdown happened today in terms of the 4 major index markets. Now let's take a look to see how the specific trade set up in each one of those markets. So on the S&P, using the conservative volatility box models, the one trade that we had set up was between the 7 to 8 a.m. Pacific hour when price action fell inside of the conservative volatility box models. This is step 1 of the setup. We breach our cyan entry lines. Step 2, we had the oversold signal right here with our green arrow. Our entry was any place better than the cyan line, which you had plenty of better prices for those that got better opportunities. Our bare minimum risk in the S&P was 16 points. That's from the cyan line to the outer edge of the cloud, 16.5 really inside of the S&P. And we made that same 16.5 on the opposite side. We fell short of target 2, which is the gray target line on the opposite side, which would have given us 32 points. So the remaining contracts were all taken off at break even when price action fell back down towards the cyan line. So inside of the S&P, we had a plus 16.5 points. Now we move on next to the Dow. Inside of the Dow, very similar story there as well. The Dow also was on its conservative volatility box models, also had the same sort of breach and bounce from the Dow. The only difference was the risk involved. The Dow was about 115 points. That's again from the cyan line to the outer edge of the clouds. We're looking for that same 115 on the opposite side. Went to max of 150, falling short of target 2 by just a little bit before price action reversed, taking out the remaining contracts at break even. Now we move on to the 3rd market, the Nasdaq. The Nasdaq, again, a little bit less volatile compared to the S&P and the Dow. In the Nasdaq, we were on the doomsday aggressive models. There, the risk involved per trade was about 63 points per contract. That's from the cyan line to the outer edge of the clouds. And inside of the Nasdaq, you'll see you really had one candle giving you the opportunity for the entry. So if you were quick enough, you got it. If you weren't, the S&P and the Dow were the 2 places you could have had a better opportunity to enter given a little bit more time. Same idea though, fell short of the 2nd target before price action reversed here, taking out any remaining contracts at the break-even price. And finally, we have the 4th market, which was the Russell, the least volatile out of the bunch. inside of the Russell, the risk involved in that same hour was 5.7 points. We made the same 5.7 points, going all the way up to 9 points, but still falling short of the second target. After that, price action reversed one more time, breaching the sign lines in the 9 to 10 a.m. Pacific hour as well. But there, we hit T1 before we actually got the edge signal confirmation. So no second setup here inside of the Russell, just the first one in that 7 to 8 a.m. Pacific hour, where price action breaches the sign lines and bounces from there in all four of the major index markets. So just a quick recap here. This was the breakdown for today's trades. This was 16.5 points on the S&P, the Dow 114 points, the Nasdaq 63 points, and the Russell 5.7 points. Now, for those of you continuing to trade the rest of the week in terms of what the outlook looks like, if I zoom out and let's switch over to a chart of the S&P here, and let me switch over to the trend lines that we've been monitoring. So far, the S&P seems to be respecting this downtrending channel very effectively. We've broken down. We had the little bit of pause that we expected after our major sell-off day, and today that selling continued. So now what we look for in terms of continued selling is down to at least the midline of this channel. The midline right now would take you really near that 390 to, let's call it, 385 mark as a potential zone. The bottom end of this trend line still a bit of a ways away, and I don't think we're falling straight down there, but that would serve as your stretch, your greedy target in terms of that 350 level. All right, so hope this video was helpful for those of you trading this volatile activity. Take care, everyone. Good luck trading the rest of this week, and we'll see you in the next update.